Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be comparing stocks versus real estate investing to figure out which investment is actually better. So I've made some money in stocks, I've made some money in real estate, but in this video, I just want to take a deep dive into the pros and cons of each to figure out which is best for you. Before we get into it, I just want to announce that I do have an email newsletter starting this week. And if you're interested in signing up to get all the notifications of when I post videos, money advice tips, things like that, just click on the link below and it's absolutely free to sign up. So without further ado, let's get into the pros of stocks first. So the first pro of investing in stocks is that there's a low barrier to entry, okay? So what I mean by that is that typically, if you want to invest in one stock or one share of a stock, let's just call it Johnson & Johnson, for example, at the time of this recording, Johnson & Johnson is pretty much trading at about $130 a share, okay? Now, if you want to compare this to, let's say, a single-family rental property or investing in a real estate syndication, for example, you're typically going to need tens of thousands of dollars to get started in those kinds of investments. So this is relative because let's just say, you make 15% on Johnson & Johnson. Let's say you make 15% ROI on your single-family investment property. You're still making 15% across the board. However, I think for most newbies, this is a pro because they can get started today for 130 bucks. And if you use like a M1 Finance or if you use even like a Betterment, you can almost invest in fractional shares as well to where you don't even have to come out of pocket with $130 for one share. So there's a lot of stuff on the market to where stocks may become appealing to beginners because they may not have that $30,000 down payment or the $50,000 payment for the syndication. They may get invested with stocks because of the low price per cost or low price per share. Again, it's all relative though. So this example is using physical real estate and also syndications. If you do want to invest in real estate using a platform called FUNDRISE, I'll leave a link in the description below. You can invest in real estate just for 500 bucks starting, which that could be the best of both worlds in my opinion, but it's outside the scope of this video. So the second thing is that stocks are very liquid, okay? So when I mean by liquid simply means that something is able to be bought or sold relatively easily. The reason why stocks are liquid is because there's brokers that have access to hundreds of thousands of people with efficient markets, technology, that are willing to sell or buy that share of Johnson & Johnson stock. So there's always going to be someone on the other side of the transaction for Johnson & Johnson. You have Bob in Baltimore. You have Sally in San Antonio. Bob wants to sell, she wants to buy. There's an efficient market here, so it's relatively easy to buy or sell the stock of Johnson & Johnson. So that's another pro for stocks, is that they're very liquid. The third pro for stocks is that there's no physical work required. Okay, so it's not like where you buy a fix and flip property or you're renovating a single family home for tenants. There's no work, okay? So the only work that typically goes into investing and buying stocks is that you may have to research some stocks, you may have to read some annual reports, you may have to understand the brokers that you want to invest with, but this is not necessarily physical backbreaking work. So a lot of people actually invest in index funds where they literally just deposit their money and let it ride without even looking at it for months at a time. So if you watch my last video about Vanguard index fund investing, that'll actually teach you a little bit more about what I'm talking about here. The fourth pro of investing in stocks is that they're flexible. So what do I mean by flexible? They're flexible in the fact that you can allocate them into retirement accounts like a Roth IRA or even a 401k, for example. These are both great ways to invest, either tax-free or tax-deferred. And then you can also allocate money into them just on a speculative basis. If you think a certain stock or a certain index fund or a certain mutual fund is going to grow over time, you can just invest in that fund or that stock specifically. If you think it's going to go down, you can short the stock, which I made a video about that a few weeks ago. But the nice thing is that you can actually allocate your money in stocks however which way you want. So to be quite fair though, you can still invest in physical real estate using a self-directed IRA or a self-directed 401k, but that's beyond the scope of this video. So let's get into the cons of stocks after this point. So what is the first con of stocks, or perceived con? So the people that like investing in real estate, the first thing that they'll say about stocks is that they're not tangible. So what does this mean? So tangible is something that you can touch, feel, smell. Stocks, they used to be paper. So if you bought a share of Ford, 60 years ago, 50 years ago, you would literally get a certificate or a piece of paper saying, hey, you own X amount of shares of Ford Motor Company, okay? Now, those have literally just become pixels on a screen for the most part. Companies rarely, send out physical paper at this point because it's not necessary. So stocks are literally pixels on a screen. They're not tangible. You can't touch them, you can't feel them, you can't smell them. So as opposed to real estate, where obviously I'm sitting in a house right now, or I'm standing in a house right now, I can live here, I can touch it, feel it, smell it. So tangibility is a big one for people that aren't a fan of stocks. So the second con of stocks is that you can't control them, or you can't control their value, okay? So let's take the Greek economic crisis, for example. So I'll draw the Greek flag, or I'm going to butcher this. Sorry to all my Greek friends. Let's see, it's the little thing in the corner here, right? And then they got the stripes. Okay, not terrible. I'll go eat a gyro for lunch or something after this. Sorry about that. So the Greek economic crisis affected American stocks negatively. So can you control the Greek economy or the Chinese economy or the whatever economy? No, you can't. So it's out of your control, meaning that just because somewhere else in the world is doing poorly economically, they may trade with companies in your portfolio, hurting that company, ultimately hurting your portfolio. So the price of a stock is the price. You can have foresight into where that stock may go in the future, but you can't control it. So real estate, you can actually force the appreciation, which we'll talk about later in this video. The final con about investing in stocks is that sometimes people become very married to their positions, okay? So it can become very emotional and irrational. So I'll draw a picture of a head, and I'll draw like these little, I don't know what to think, it's stuff coming out of my ears, I'm angry, I'm irrational, I'm confused. So if you're investing, especially in individual stocks, and you're not disciplined, it can be an emotional ride, and you can actually get very emotional and make emotional decisions. So who here has regretted making emotional decisions or doing something out of emotion as opposed to logic? I know we've all either been, in an argument with our significant other, or we've been in a heated battle on the playground, or whatever. It could be a sporting event. Sometimes our emotions get the better of us, and we make rash decisions or say things that we don't really mean. So in today's world, we're bombarded by news, social media, and nonstop commentary about XYZ stock and about what XYZ company is doing. So in fact, I actually think that social media creates bubbles, such as Bitcoin and things like that. I'm not calling Bitcoin a bubble. I'm just saying its meteoric rise last winter. I think a lot of that was due to social media and fear of missing out, but we'll discuss that in another video. So emotion and irrational buying decisions, that can definitely be a con for individual stocks and also certain portfolios. Okay, now that we've talked about the pros and cons of stocks, let's talk about some of the pros of real estate. So real estate is one of the most powerful wealth building tools throughout the history of pretty much the world. Okay, there's always been lords and serfs and landlords and people that live in their buildings or occupy their space for their business. This is basically the landlord and the tenant relationship. So the first one with real estate, the first pro, is obviously income. That's why you own these properties. So real estate produces income in the form of residential or commercial leases. So people need a place to live, businesses need a place to conduct business and operate, store their equipment, things like that. So depending on what type of property you're in, whether it's like single family, whether it's residential, whether it's apartment buildings, whether it's flex space, whether it's retail, industrial, whatever, you get the picture, you're creating a stream of income or cash flow. So every month, or however your lease agreement works, this property is shooting off cash flow, okay? So if you're an efficient manager or have an efficient manager working for you, if you keep your expenses low and your leases are at market rate and you're providing a good place for that tenant to either live or conduct their business, you should be making a profit. So to be 100% fair, there are definitely stocks that throw off dividends, which can be looked at as rent. So I just want to make that apples to apples comparison, but income is definitely the first pro of owning real estate. So the next pro of real estate is that it's tangible. So unlike stocks being those pixels on a screen that we talked about, real estate is a real tangible investment. You can touch it, smell it, feel it, walk through it, sleep in it, live in it. For some people, it makes them more comfortable investing in a tangible investment rather than something that they can't see or feel. So it's one of those things where it's like see it to believe it. That's why a lot of real estate investors prefer real estate as opposed to stocks. The next pro of investing in real estate is the depreciation, or we can even call this like tax benefits. This is just one of the tax benefits, but I want to talk about depreciation specifically. Depreciation. Okay. So the IRS uses depreciation to recognize that an asset obviously has a lifespan or that it wears down over time. So depreciation is considered a paper loss, which means that you didn't actually spend any money or incur any money out of pocket, but you still get to write off that perceived expense. So there's a schedule of 27.5 years for residential, 39 years for commercial. So say for example, you have a single family home, you're realizing all this rental property income and your tenant is paying you every month. You still may not have to pay the full amount of taxes on that exact gross income because you're allowed to depreciate that property over that 27.5 years. So the IRS really likes real estate and they want to keep that blood flow or the circulation of real estate going within the United States specifically, and that's why there's a lot of favorable tax advantages to real estate, depreciation being just one of them. So the next pro of owning real estate is equity. So equity is pretty much what your ownership percentage of the property is. If you owe nothing on it, you have 100% equity in that property. So the nice thing about real estate is that you can use debt to acquire real estate. So the income from your tenant is actually paying down your mortgage. So say for example, you buy a $100,000 house, you get into it with a 20% down payment, meaning your cash outlay is $20,000. This $80,000 plus interest over time is being paid down month after month after month by the tenants that live in that property, okay, or use that property. So basically, your cash outlay is 20 grand. The rent that you're receiving from this $100,000 property is being used to pay down this debt, thus increasing your equity, okay? So you're owning more and more of the property over the course of 15 years, 30 years, whatever, however fast you pay it off. That way you get 100% equity in the property, meaning you own the whole thing, but your tenants have been the one that's been paying off your mortgage. Get it? So at the end of the day, you may control this asset that's worth $100,000 or more after those 15, 30 years or however long that mortgage was on the property, but you own 100% of it after this is paid off, even though your cash outlay was only 20 grand. Okay? So with that, in that same vein, let's talk about appreciation as the next pro of real estate. So appreciation is simply what it sounds like. It's how much a property appreciates over time. So over the long run, real estate has typically averaged, I'd say 3 to 4%, right around there. It's kept up with inflation, if not beat it just a little bit. But there's obviously, a lot of areas in the United States like the San Franciscos, the LAs, the New Yorks, the Austins, the Denvers, for example, where appreciation has been, multiples of that. It's been significantly higher than 3 or 4%. So the other thing with appreciation with real estate is that, and I mentioned this earlier in the video, is that you can force appreciation, meaning that if you have a property that's in an area where all the rents are going for $1,000 a month, and you find this old building that may be a little bit under the weather, a little bit dilapidated, where the rents are $750 a month, you have the ability to raise all the rents of those apartments by $250, meaning you're forcing the appreciation. So you acquire the asset for X amount of dollars, you do all the updates that you need to do, and now you can rent out those suites for $1,000 a month and get it to market rates. So that's what we call forcing appreciation. And finally, the last pro of real estate is another tax advantage that I saved for its own separate category. So this is going to get somewhat technical, but just stay with me here because it's super powerful. So I worked in commercial real estate for 3 years here in Northeast Ohio, and I met a lot of wealthy people and a lot of wealthy developers. Real estate developers are typically cash poor because all their money is in the deals that they're either running with or sponsoring or putting together with their own money. However, on paper, they're worth a lot because they have all these assets. So the way they protect those assets and also the way they protect their gains from building the asset, selling it, and not realizing the capital gains tax is with what we call a 1031 exchange. Okay? It's not literally spelled like that. It's exchange. I spelled it like that for no reason. So this basically allows an investor to sell a property, reinvest the proceeds into a like and similar property, and defer all the capital gains tax. So here's a perfect example. Say someone sells a building and they realize a $400,000 profit, and they have, let's just call it, I don't know, 400 grand that they want to invest into the next property, okay? So without the 1031 exchange, this 400 grand in proceeds really turns into like 260 after all the capital gains taxes and everything is incorporated, okay? Now, if you do a 1031 exchange and find a like and similar property, the IRS will allow you to roll over this entire amount without taking any of those taxes out. You're allowed to defer those gains, and basically you're left with $400,000 instead of 260. So why is this powerful? So let's say that person is investing into a like and similar property. Let's just say they sold an apartment building, made that 400 grand. They're ready to invest in another apartment building or another income producing property. Instead of taking that 260 and being able to buy a property that's worth $1,040,000, that real estate developer or that real estate investor can take that 400 grand, roll it into another, either a nicer or better property that costs $1.6 million, okay? So it's getting you into a better property, it's getting into a property that could produce potentially more income, and you just repeat that process over and over again. So when do they have to pay taxes in the 1031 exchange? Well, they can keep deferring these until they die. That's actually the goal, is defer, 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 and then die. So they have heirs where these properties go to, but the heirs don't have to pay the taxes that were deferred. They just inherit those properties at that basis, okay? So whatever the property was basically bought for, that's what they're in it for, okay? And that's when the capital gains basis starts. So I know that was a little bit more technical than you guys are used to, but I think it's super important. So with all that being said, hopefully you had a chance to either rewind or pause that portion of the 1031 exchange. Let's get into the cons of real estate. Before I do that, check out the links below. Again, if you haven't signed up for my newsletter so you never miss another video or a blog post or even any money advice, sign up for the email list below, please. So the first con is that real estate is illiquid. Okay, so you know how we talked about stocks being super liquid. You can buy, sell, trade. There's a but for every seat. You know, there's Billy in Baltimore, Sally in San Antonio. They're always going to find a buyer and a seller in that market. Real estate is not the same. So you can't just buy and sell real estate like you buy and sell stocks. Sometimes properties sit on the market for years unless they're deeply discounted at some point. So keep that in mind. The second con is that diversification can be difficult. Diversify. So what I mean by that is that let's say you're a typical landlord, you started off with a single family home and you never got outside of that product type. Let's just say you own 50 single family rentals, okay? Instead of diversifying into other types of real estate like industrial or retail or office space or whatever, you just keep buying these single family homes, single family homes, single family homes. And let's say you do become, somewhat sophisticated and buy a bigger apartment building. Let's say that's the only apartment building in the town and a big employer that employs 90% of your tenants actually goes bankrupt and they go out of business. So since you weren't diversified, you only had those 50 single family homes, you only had the one big, 50 unit apartment building, you may have just lost, half your tenant base right there because they don't have enough money to pay you rent. So if you own a bunch of those single family homes, let's just call all these single family homes, and that big employer goes out of business, a lot of these people may not be able to pay their rent, and now you have a building that's not performing, okay? And then who's going to pay for the property tax? Who's going to pay for the utilities? Who's going to pay for the maintenance? Who's going to pay for advertising? That all comes back to the landlord. So diversification is dangerous if you don't diversify with real estate. So the second last con, and stick with me here, if you're still watching this video at this point, I really appreciate it, you guys. You guys are the real deal. The next one is that it can be lots of work, okay? So real estate as opposed to stocks, depending on how you set up your business, stocks, as we mentioned, are literally like no work. Real estate can be work intensive. So it all depends on your investment style. It all depends on what property type you're investing in. If you find, a syndication where someone else is managing it, someone else is running the deal, you just invest 50 grand, for example, okay, that is a relatively passive investment. However, if you're the, the barber running the barber shop, for example, and you're buying these single family homes and you don't have a manager in place, well, guess what? Who's taking the calls? Who's doing the maintenance? Who's doing all this stuff? And then finally, we mentioned this very early on with the stocks. The last con for real estate is that it's a perceived or is a high barrier to entry, okay? So when people see real estate, they can be intimidated by the price tag. It's definitely more expensive than stocks. Again, it can be more intimidating. The advice is to educate yourself using resources like biggerpockets.com or forums or podcasts. The best advice that I can give you to get into real estate is not try and do it all yourself. Yes, it's more rewarding and you may see a higher ROI, but if you build a team, if you have a real estate agent, a CPA, contractors that you can trust, you can get out of this high barrier to entry if you just systematize the business. So again, you guys, check out the links in the description below. Join the newsletter. I hope you got value out of this video. This video was a little bit harder to shoot because there's so many components and moving parts, and I wanted to make sure that I captured everything. So if you watched till this point in the video, please give the video a like. Please subscribe to the channel if you haven't already. Share the video with a friend, and as always, have a prosperous day.